Hello, everybody. Welcome to Talk Money with Tom. Welcome to Friday. Got Marie with me today. Actually, Eason is on vacation, so we're trying to keep the show going here. She's actually got some pretty unique experiences. We'll talk about some of those that come up with some of the questions. Uh, Obviously, this is a show designed to try to help people with their retirement, especially on the financial side, retirement planning, asset management, what to do to reduce taxes during retirement. So if you're already retired, there's obviously going to be a lot of things here that you can grab onto. If you're not retired yet, these are things that you can start to work towards to improve your retirement. We believe that education is super important, and so we basically set this up as a question and answer show, just to be able to answer people's questions. You can send those in now. Ask Tom, talkmoneywithtom.com. You can put them into the chat, and we'll try to answer those live. But we have some questions that came in through comments and through the email. And then we also have some questions that came up over the last couple of weeks from client review sessions that we have too. So we'll discuss those. Of course, you can subscribe to the channel. Again, even if you have an advisor like we are, it's still a good idea to get, a base of knowledge about all of these areas, what to do with your Social Security, what to do, in terms of how to manage the money and those types of things. We just eclipsed 1,500 videos now on the channel, and so there's lots of things to look at there. Put out a video every day on what's happening with the markets and such too. So go ahead and subscribe to that. Hit the bell button to get notified. Throw in a like if you like it. Those kind of things. And then lastly, of course, if you want to, just you can meet with me and/or Eason. And that's pretty easy. We have a link for the website right here on the channel. For our homepage for our business. There's a book appointment button, looks just like this up in the corner, and you can go ahead and schedule a time. Our schedule is live, 30-minute session for phone, video, in office, whatever works best for you. So really looking forward to today's show and hope everybody kind of grabs something out of this as far as that goes. Always start off the show with a summary of kind of what I saw happening in the market this week. So let's pull up the chart. All right. So this is a S&P 500 going back to 2019 in this particular case. This is weekly data, so it's a little bit smoothed out as far as that goes. You can see the big pandemic drop there, and then all the money that came flooding out caused a really impressive rally out of the bottom of that downturn back in 2020 and 2021. Eventually we hit that peak at the very beginning of 2022, and that was really when inflation started to hit, and the Federal Reserve started talking very aggressively and raising rates and cutting back on the purchase of bonds, and eventually actually starting to sell bonds and all those different types of things. So this run that we've had, and you can see right over our heads there, kind of looks like maybe a 60-degree angle. It's pretty smooth. It's been a pretty darn good run here, and if you look at what happened this week, I don't know, we're seeing a little bit of topping action this week. Today, the market was actually happy because the job numbers came out. It was 275,000 jobs created. That was more than expected. And we keep getting, I think almost all of the reports that I can remember in the recent times have been better than expected on job creation. So that part's going very well. The market used to react to that fairly negatively when it was higher than expected because there was some fear of that inflationary force. But now, in the last many times where that's happened, the market's actually responded positively. So it was up a fair amount this morning, came back down. I think there's some profit taking going on, and there's been some things that have just run so high. But just to put a bow on the jobs portion here, if you have high inflation, and part of the reason is because there's a lack of supply. One of the things that's happening is that you want more supply. So when it was goods, right, when we were all locked up, the supply was being choked up in the ports. You had trouble in making it in China because the factories were closed down, or what have you, or just moving things was hard. That goods motion has gotten quite good. There's not a problem. And people have cut back on purchasing goods because once we were able to get out, we want to go to restaurants, we want to go travel. And so services became the choke point. And services generally take labor. And so, there's still over 9 million jobs open. and a lot of those are service jobs. And so, you need people to take those jobs in order to, be able to meet the demand. And so that should help inflation. Um, so that's a piece of what happened. To me, that's good news. Every time there's more jobs created, I think that's a good thing. Uh, the market will look at that in one way and say, hey, now the Federal Reserve might not lower rates even longer from now, just because the Federal Reserve has a dual mandate, what they call full employment, right? And what they, for 2% core PCE inflation. Okay, those are the two biggies. Full employment is considered 4% unemployment or lower. That actually went up a little bit today, went up to 3.9% on unemployment rolls, but still within the full employment realm. So this week was a lot about what was going to happen with Chairman Powell's testimony in Congress. Both days that he was testifying, Wednesday and Thursday, the market went up in the end, kind of came down Monday, Tuesday prior. And there's some fear of what might happen and what he might say. I know that we talk a lot about the Federal Reserve, and that's because this is the key issue that drives the market in general, but certainly now in a higher inflationary environment. So during his testimony, he was pretty clear about the fact that it felt like interest rates would be coming down at some point in this year. They needed to feel confident that inflation was, truly coming down and not going to pop back up. And he said that they feel like they're fairly close to that confidence level. Okay, so feeling confident. Now, the thing that struck me and has been striking me really maybe since December is that the Federal Reserve at the very top here in November of 2021, that's the first time I've heard the Federal Reserve say very aggressive things about raising rates. Usually they keep things kind of close to the vest, and what they're doing is what's called job owning. They're basically trying to, put fear out there for the stock and bond markets and credit markets, where people will pull back, the market will drop, people will feel a little poorer, they'll start to, save their money. There won't be as much, growth happening in these companies, and, things that they needed the demand side to slow down. So they were talking the demand side down, and then additionally doing the actual things of raising rates and cutting back on bond purchases and selling bonds out of the portfolio, quantitative tightening, going from quantitative easing and quantitative tightening. So, but now in the last, 3-4 months here, we're starting to hear things a much different tone. And I think part of that is actually part strategy just going the other direction. So if we're going to go after the market and try to bring it down to slow down inflation, and at the same time now we're looking at possibly lowering rates, we can use the market to let it run some, kind of keep inflation from falling too far into a deflationary role, and quite possibly from keeping the country from falling into a recession also, just because again people have more money when the stock market goes up or the bond market goes up. And so I think there's a strategy shift there where they're trying to be nicer. Not all the Fed governors, believe me. It just really Chairman Powell's the one I'm mainly focusing on here because he was testifying this week, and I think that they're going to be more accommodative, and I think they're okay with the run that's happening in the stock market because, again, it might mean that they don't have to lower rates as soon, and they can sit back longer and maybe do 1 or 2 rate cuts this year towards the end of the year, that type of thing. And so which I think is a good thing. I think if that's true, if that strategy is actually playing out, that means that the Fed is on the side of the market, and they have a saying that's, I think, very accurate: don't fight the Fed, right? So when the Fed is raising rates, or in this case also talking aggressively about raising rates and all those things, the market comes down, which is what we saw in 2022. The market came down 28%, in the S&P 500 from high to low, bottomed out October 13th of 2022. And so let's talk about this run, because there was some other news that came out. We finished a 4-month run, November through end of February, and it was 21.4%, on the S&P 500 in that 4 months. There's only 3 other 4-month runs, going back to World War II that are anywhere close to that. Coming out of the recession in 2009 was one period. Second period was, the second, kind of recessionary recovery period was right here on this chart, ending in June of 2020. We had a recession, short one, but during the pandemic. And then the third one was sort of the, dot-com bubble. During the middle of that dot-com bubble there was a 4-month period that was like that. So if you go back and look at those, what you'll notice is that they continued for quite a while. If you look at this chart here, the top was the end of 2021, very beginning of 2022. The best 4 months ended in June of 2020. It ran for quite a while after, right? And so to me, I'm kind of a big believer in momentum. I think things get going in a certain direction, and we're going to continue to see momentum potentially out of this. You can stop momentum, but big momentum like this would take something big, right? Something really unusual happening, and that's always possible. I always call those the wild card scenarios. But if you look at just kind of the basics for what's happening here, this could run for a while. And we've got this combination of pent up demand coming out of the pandemic, and we have the artificial intelligence pieces. NVIDIA's earnings were real. I mean, that wasn't a fantasy. It wasn't a mirage. I mean, they blew the numbers out. I don't know if you could do any better than what they did, to be honest. And so that's gotten the market excited about this possibility. The development of these types of motions are, in my opinion, have been fairly consistent. Look at this run that came out of the pandemic. It kind of started off with the Microsofts and the Apples. It moved into kind of the smaller cap stuff, the genomics, clean energy companies that they were real. They had actual, earnings, but they were selling at maybe 300 times those earnings. That bubble just kind of goes along, right? Bop, bop, bop. And then by the end, we were dealing with SPACs, SPA. I forgot what those stands. Special something or other. Anyway, a SPAC is an investment vehicle. They gather a bunch of money. And then they decide what to go buy it with. And I remember there were celebrity SPACs. So they had like Colin Kaepernick, the 49ers, former 49ers quarterback, was going to have a SPAC. Okay, that's when we're near the top. Okay, so watch for that, because the next time, this is the same pattern. We got real companies, picks and shovel companies right now moving. Good stuff, Aristonet, take NVIDIA, whatever it might be. These are companies that are actually, providing a little bit like what Cisco did, 95, providing the routers that the internet was going to be running on and such too. And I think the next phase will be, legitimate companies, but probably very highly priced, actual AI companies that have, some product that they're coming. And then we'll get to the bingo.coms and the SPACs and the things that'll come at the top. And so we do kind of want to watch for that. Be interesting to see if this, run plays out like that. Again, this is unusual, okay? That motion right there, the smoothness, the steepness, the actual 21.4% move over the last 4 months is not a normal scenario. Again, we can point to 3 other 4-month periods like that, going back to World War II. So this is not something that happens very often. But in every one of those cases, the market continued to move. There is momentum. You kind of get it's like a big ship. It just gets going and it keeps on going. And so, we had a day this week before Powell's testimony, dropped 1%. And, we made that back in 2 days as the dip buyers came in. Today, looks like it might be another negative day. But, when there's this much momentum and this much money sitting on the sidelines, they're looking for opportunities to buy and to come in. Whether it's a professional investor or the retail side, both seem to be kind of coming in. The professional investors were at the very bottom, right, that little spike right between Marie and I was the 27th of October. The Bank of America survey of the big money managers, they had the lowest exposure to the stock market in the last 72 years. Exactly when you didn't want it. It jumped 9% or 8.9% in March. In November, just right after that. So there's a lot of money coming in there, catching up, trying to move. And then there's trillions of dollars in money markets and CDs and such, when 5% looked great, it really did. And now, you got a 21% run in 4 months. People are starting to look at that. I'm getting clients saying, hey, I got some CDs coming due. I'm only getting 5. It used to be, I'm getting 5. I'm really happy, So again, that's the money that'll fuel this rally for a while too. And again, this rally is based at the moment on very sound things. I mean, even though Nvidia has doubled its price and continues to go, it's nearly $1,000 stock today. Got to 979 at its high. Um, you know, it still has its PE ratio still coming down because the earnings are growing faster than the stock, which is very unusual. Which probably means that stock continues to grow for a while just to catch up to that level. So, very very interesting week, very interesting time frame. And don't be afraid of it. Let things run. I'm not a big believer in trying to grab profits off the top, because what is the top? I'm actually a bigger believer of letting your winners run and put a safety net on there. So if you have some Nvidia and you're wondering what to do, put a 25% trailing stop. So a trailing stop just means that, when it drops 25%, it would sell off of the highest price that it had. So as the highs get higher, it drags the stop upward. So you don't really have to do anything. Usually you have to renew them every 6 months or something. But and that way, you maybe not all your Nvidia or some portion of it, whatever. Take a quarter of it. Take whatever you made in profits. Take those shares and maybe protect them with the trailing stop. And that way, it goes to 1,000 and then does a big split and then goes up again and again. You just ride it, let it go. But if it drops more than 25%, the story could be over, right? Something's over potentially. So yeah, taking some off the top then makes some sense. It'd be great to take it out right at the top, but I mean, I have situations where clients have sold Nvidia years ago, at $90 a share. It's at $900 because they thought it was too high. Just let it go. Wait for it to fall apart before you really start to do that. If something has momentum, let it go. Let your winners run. Because when things fall, it falls hard. So it's hard to get a winner. If you have one, let it go. So anyway, that's the summary for kind of what we see happening in the market. It's a great time to be an investor. A really really good time to be in there. And don't be afraid of what's happening right now. I do think we will be in some type of a bubble type category. I think things move faster. The dot-com bubble was 5 years. This is probably going to be 2 or 3 years. Be my guess. I mean, you look at the 2020 run. We went from April of 2020 to the end of 2022. That's what, a year and 3/4-ish, and that was a huge run, and then it stopped. Right. Again, got into the bubble category quite quickly. Money moves very quickly now, and so we're probably going to have a lot more of these type of crazy runs. The stock market is a representation of human emotion, and you get a bunch of humans in a herd mentality, the market can go really far either way, in that environment. So you just have to kind of be divorced of that emotional portion and take a look at it, analyze it, see what's happening, and try to move with that, kind of analytical look. Put your emotions to the side if you're going to be a good investor, would be my opinion. And be calm and make good choices. So this is a good market. Celebrate it. Let's have fun. So anyway, thank you for joining this summary today. Look forward to being able to do this again. We will not be actually having the show next week, but I will do the summary anyway, just to put out for the market. Okay, so let's start with our first questions.
Okay. Happy Friday, everybody. Our first question is how to recognize and avoid a scam.
Oh, okay.
It's a tough one.
Yeah, we actually get some exposure to this through the clients, right? And things that they've been involved in, and situations that have come up. And so I think this is probably the second time we've done this type of video. And it can be really scary and quite, nerve-wracking for anybody that ever gets involved in this. I think on a regular basis, we're all probably inundated with some form of scam attempt, right?
And they're getting better and smarter and using technology, right?
Yeah, it's no longer the stupid story about the Nigerian prince that you're trying to save by,
and by fax.
Yeah, by fax. Yeah. Yeah, exactly. It's the stories are better, the techniques are better, but there are some basics, and one of them is just the craziest thing, actually, because it's just a silly saying, but if it's too good to be true, it probably is. And I'll tell you
And it
what,
usually is.
and it usually every time we finally find out about a scam, whether it was Bernie Madoff, who was like consistently doing 12% a year when nobody else was, it was too good to be true, right? You look
Mm-hmm.
back at all these things. There was this big technical equities scam here that happened back in the 80s. And the same thing, huge rates of
Mm-hmm.
return. People are borrowing against their house. I remember they had to put up like a circus tent at the court because it had so many defendants.
I remember that.
Yeah,
Yeah.
it was crazy. And
Yeah.
so, and I'm thinking to myself, if I'm sitting there trying to show these guys some Vanguard funds, they're not going to borrow against their house. I wouldn't even want them to, right? But again, it's if it's too good to be true, that's where it starts. Okay, there's something happening here. If you think you just won the publishing clearinghouse lottery or whatever might happen, hey, just slow down, take a breath. So there are some basics, right? So one of the things that you always want to do, somehow or another, you want to contact that organization independently. So let's say you get a call or an email or whatever, or a text, right?
Mm-hmm.
And they're offering something, and it could be legitimate. You want to check. You want to go yourself. Don't ask that group or person for the info.
And don't call the number on whatever it is you
No,
received.
no. So
Yeah.
let's say they're doing something with your credit card.
Mm-hmm.
And they want to know your credit card number and your the little 3-digit code or something, which the credit card companies keep saying, hey, we never asked for that, but nonetheless, what you'd want to do is you get out your credit card and you go to the phone number on there and you'd call that phone number independently and you say, okay, is this real, right? Because it's basically if they give you a number, they could spoof that number. They could be the one answering that. And you think
Yeah.
you're calling your credit card company and you're not. You think you're calling your bank and you're not. These scams are way past that. They're very sophisticated, right? There's a lot of money in it.
Yeah, and what spoofing is basically if somebody takes the Bank of America phone number, say, and they have an app that they can download and put that number in and make it look like they're calling from
Yes.
that phone number, and
right.
it doesn't. It's not true. It's not
Right.
accurate. So if you go, like Tom said, you look on the back of your credit card, or you go directly to the bankofamerica.com legitimate website, go to their contact and find their phone number
Yep.
and call them directly.
Yep.
Don't rely on somebody who sent you a text or called you posing as your bank or what have you.
Yeah, exactly right. Because you can spoof a number on an outgoing call fairly easy with an app. I can
and
put
location. You can
and
make it look
yep.
like San Jose, California.
That's right. But
Mhm.
it's almost impossible to spoof an incoming call with a number that's controlled by, let's say, Bank of America. Intercepting every one of their phone calls to try to capture yours is probably not going to happen, right? So, same thing. And so, there's a lot of different types of scams, right? There's the
Yes.
ones I kind of put them in a couple categories. There's the ones where somebody says you got something, but in order to get that, we need to get something from you, right? That's kind of how it works.
Like a wire transfer
Yeah,
or
like, hey,
something.
you just won all this money, but you have to pay the taxes first. Okay, so send us $1 million or something for taxes or whatever it is, right? And so, obviously that's the too good to be true scenario in a big way.
Yeah, and if somebody's asking you to put money in a box or withdraw from your bank and ship
Right.
it to a PO box,
Right.
No.
Right, yeah.
Don't do that.
Probably not a good idea.
Yeah.
So, you want to, go find a way to independently verify this that is completely unknown to that person that you're talking to. And you go around and find the phone numbers, websites of legitimate pieces, not based on their advice, just based on your own work as far as that goes. The other type of kind of scam really is the investment scams. And these are the biggest ones, actually. The Bernie Madoff was billions of dollars, right? And went on
Yeah.
for a really long period of time. And just so you kind of understand the basics of how those work, they bring in money, they offer a rate of return, oftentimes, again, too good to be true, 10, 12, 15, 18%, sometimes even guaranteed, which is, again, too good to be true. And when you see that, what they're doing is to take your $100,000, they're going to give you $10,000 back every year as your return, and they're just going and getting other people's money. And so, they get enough money coming in, they can pay all that out, and then they skim a bunch off, like half or something, and that goes into their lifestyle and what have you. they all fall apart. Those pyramid schemes, what they call it, they all fall apart. Like in 2008, there was a whole bunch of them, including Bernie Madoff. And it's because they're not gathering as much money in as it's going out, and the whole thing breaks down. With Madoff, because of 2008, people needed money. And I know the owner of the Jets, for example, was one of their big investors, and he needed a bunch of money back because they were having some financial difficulties. Mm-hmm. And of course, he didn't have it, and Madoff essentially turned himself in at that point. So, but here's a way to kind of verify some of these things. First of all, one of the things that they do is that they will produce their own statements, right? So it looks like you have the money. And it might even be with a legitimate company. It could be with, Fidelity or whoever. And they're producing these statements and sending them to you themselves. I've heard of situations where they actually are able to open up an account in the name of some of these firms, right? Mm-hmm. And so they take your money, you're writing out a check to Fidelity. I'm making that up. I don't know if it's Fidelity, but just whoever. They deposit it, they manage to get an account open in that name, and then they're producing statements. Of course, they're taking the money off and, ripping you off on the other side. But you can get around that by having your own access to the portal inside of that, custodian. Yeah. And one of the reasons to use the big custodians because they're the easiest to really identify. So if you have a Fidelity, a Charles Schwab, whoever, you go to the Schwab portal, for example, and check that account and see if it's there. Because they can make up a statement. They can't intercept, it's much, much, much more sophisticated to intercept your request into that Schwab portal that you set up on your own. Mm-hmm. And you'll find out you don't have an account. So I always think that the portals are a really good fight against this type of Ponzi scheme to really see, because it's a different entity. Schwab and whoever it is, let's say it's me as an advisor, right? I don't have the money. Schwab has the money, right? Mm-hmm. And that's good, right? I mean, it's two separate places.
And you're not writing checks out to the name of our firm. You're writing them to Charles Schwab, and they are the custodian, meaning they hold the money that if for some reason we weren't available, we're available. But you would be able to contact Schwab directly, just going to schwab.com, charlesschwab.com, and call and double check, if there was some, we don't have statements that we create. They're all created by our custodians. So we don't hold the money. We just are the advisor for that money.
Yeah, and even if we were creating the statements, if you went to the Schwab portal, we can't create that.
No.
Right? No. So that's the place to check. I think it's a great, safety net. You get some other information, it's worth having access to a portal. You can see, what happened that day or the last month or whatever. So anyway, that type of crime with an investor, an investing thing, those are the big dollar amounts. A lot of them are unregistered. They're hedge funds. They're not registered investment advisors like we are, because it's so much harder to do something like that in a business like this. The other type is just like, stealing your credit card number, right? You go to the gas station
Skimmers.
And they have a skimmer on the gas station pump. So there's a couple tips that I've seen over the years I think are important. Number one, try to use the pump that the cashier can see, because they generally do these skimmers, for example, in places they can't see. They could be on an ATM machine.
Or an ATM machine in a store.
Yeah, like the liquor store, that seedy liquor store down on the corner, so somebody has a scam. But one of the things that they do talk about, and it's very difficult to really tell, but usually the skimmer actually creates some kind of bulk for it doesn't look quite right.
Looks clunky and bulky.
Yeah, so I'd be a little suspicious of that. Now, generally speaking, somebody gets your credit card number, your credit card company's kind of on the hook for that more than anything for the most part.
You'll usually get your money back.
Yeah, I've had a whole bunch, and it turned out to be one of them. I think it was 3 times. Turned out to be one restaurant we were going to. The restaurant's now closed, but they figured out on the phone with me on the 3rd time. They told me, "Hey, this is the restaurant we think is stealing your credit card number." And so somebody would be buying some $600 boots in Georgia. And I'd get a text saying, "Is this you?" No. And I don't think I've ever spent that much on boots, actually. I can't remember. So anyway, but it's something to watch for. It's just a major pain in the butt because I usually have a lot of things attached to the darn card, right? And then you got to go back. And unattach them and attach them to the new card, and then they cancel your card. You might not have a card for a little while, that kind of thing. So, but watching for these skimmers, I think,
and watching your bank transactions.
Yes.
Because that's where they can hide and have multiple smaller dollar amount transactions that you want to verify.
And there's so many nice, online apps with each bank now to be able to look at things right on your phone.
And receive alerts, text,
Yes.
email that a charge greater than $5,
Yep.
and you get a text.
Yep, exactly. And so you can freeze your credit now so that somebody can't use that. You have to unfreeze it every time you want to use it.
Yeah, it can be a little bit of a hassle, but if you've had something happen,
Yeah.
it can be a useful
And that's
tool.
more of an identity theft thing, which
Yeah.
is the other category, right? The kind of the last category is just that identity theft arena. So, I use LifeLock. I like
do
them
as well.
too. I get a lot of false alarms, but at least I'm getting an alarm. And so something happens. Somebody tries to use your identity. I had a friend who somebody actually opened up an equity credit line against his house.
Oh my goodness.
Yeah, and so that really woke him up. And so
So you'd want to freeze your credit.
if you froze your credit, right, or if
Yeah.
you had a frozen credit, they wouldn't have been able to do that because they would have had to contact, him to unfreeze it. And there was something. It didn't go all the way through. They didn't get any money. It was like some last step, and he just happened to get some notice from this company too. So it's still something to be aware of as far as that goes. And there's a bunch of different pieces that are out there. Again, for the majority of them, there are some steps you can take to try to insulate yourself from these areas because it's just a part of life. Basically, these people have created a business. They're getting money. They have employees. They have infrastructure. They have technology. They have programmers. This is a business.
And they've learned from others, so they're well versed in the art of the scam.
Yeah, they may or may not be in the country. Who knows? But it is a very active business, and they're targeting the senior community quite heavily. They're the ones still answer the phone. You call anybody. I always get my older clients answer the phone. Otherwise, I'm leaving a message. For a lot of times. So and they also are the ones that usually have the money. All right. So it takes a while to accumulate money, and by the time we get old enough, we usually have some. So or hopefully have some, and makes us targets as far as that goes. So that's good. Good question. What else do we have for question?
The next one is this is a good one. What to consider about owning rental properties?
Oh, okay. Well, Maria has some expertise here in her family. What have you too.
I grew up kind of families owning rental properties, and one thing I always say is, a lot of the rental properties in California, squeaks, creaks, and leaks. So, meaning leaky pipes, squeaky floors, and squeaky, just older, right?
Yeah.
So if you have rental property, know that you usually want to have a cash reserve for things that can go wrong, because even if you have a tenant, you have to fix something. If a tenant moves out, you've got to have that time of lost rent. You might have to replace pipes in the whole house if you have the old galvanized pipe, termite damage in California, shifting, settling foundations and things like that. It can be a very good investment, but also it can take up time, and hiring property managers is a good thing, but that can be expensive if you're like a mom and pop place. There's probably certain things you want to keep for the professionals, like electrical, and plumbing, like serious plumbing, but usually it can be something that can be overwhelming if you have a lot of expenses that come up, and in a particular year you've spent more than you've made.
Yeah.
So that's kind of important.
Yeah, my experience just comes from, the side of, talking to thousands and thousands of people over the years, and learning things from them and their sayings about real estate. And so just on the good side, I will say, I would say with a few exceptions, the people with the highest net worth that I have ever met that have come through the practice, or our clients, have done so through real estate, mainly here.
It's a tremendous investment,
Yeah,
and you make a great amount, in your equity. You may have to put out some cash initially over time, but what you're gaining in your equity is amazing. Yeah.
One thing I heard a lot was the property manager, and I have a few clients that had a really good property manager, really happy, because a good property manager is awesome, right? I mean, even though they cost something, they're good, but there aren't many. Right? There was a lot more complaints about property managers.
It's not being available, not catching things.
Yeah, or just overcharging or all kinds of weird things on the bill constantly. Basically taking the money from the landlord. And then, unfortunately, then I'd find a good or one that I could tell somebody else about. Well, they're already booked up, because they're good. Not taking any new clients. So, the property manager, you really got to do your homework and get lucky and get a good one if you're going to do that.
Maybe get a referral.
Yeah, and then kind of the last thing, I've heard a lot of stories of almost like rental scams in a way where. There was one, a gentleman inherited a house up in Sacramento, his mother's house, and he decides instead of selling it to keep it as a rental. He's never done it before, so he just finds this lady. She moves in, gives him first, and a deposit, right?
First line.
And he never got another dime, and it was a really interesting horror story because not only was she not paying him the rent, she actually created mold inside the house.
I've heard of stories.
Some form of, humidifiers or whatever it was that she did this. I don't know. I didn't get those details. But then she sued this gentleman for the mold and for her health problems, $50,000. He fought it for like a year. So he paid, lawyer fees and didn't get any rent. And then he ended up having to pay most of that $50,000 anyway. Just to get her out of there.
And to fix it, what he had to
yeah,
fix.
exactly. So,
yeah.
So the key there is you really, really, really want to check, your potential tenant. So one of my very most successful.
Don't be too trusting.
Yeah. One of my most successful clients who has, 20 properties has done really well. He's really, really smart. Has a very, very good property manager, and she will go to the potential. If somebody's moving in, she wants to go to their place and meet with them as sort of see how do they keep their home, and what's this like. So, that seems kind of extreme, but if you see what can happen, right, and you lose that much money, that gentleman in the Sacramento house, all that money that went out, the poor guy, he sold it after that. Actually, he didn't want to be a landlord. My parents had a house here. Moved to a different house, kept the first house. It was their first house actually. Rented it out. Just had a horror story rental. I mean, it was just bad. There was like dirt everywhere. There was black all over the walls. It was wild. I mean, and somebody burned a hole in the bathroom floor right through the linoleum and the subfloor. I don't even know. I mean, I remember I was a small kid at the time, and there was looked like somebody took a hibachi barbecue and turned it upside down and just
grilling in the bathroom.
Yeah. And charred it all the way. I remember sticking my head down there and looking, at the underneath the subfloor. So, and they didn't keep that house either, right? Probably should have. It's obviously worth a heck of a lot more than they, sold it for. But that, it's. I will say the ones that do it well, it is a business. It's not just something they're doing. It's a business, and they treat it like a business. They run it like a business. They're not, super emotional about the tenants per se. You got to do the rent increases and do these things, and you got to get people out that aren't doing what they need to, that kind of thing. But yeah, there's some considerations. And then here in California, we've got a lot of weird things that happened during the pandemic where, the gentleman I just mentioned, he had a client that couldn't pay, and he couldn't get him out of there. There was no evictions for a while.
Yeah.
And even when the evictions did open up, courts were backed up for like 9 months too. So some people are getting some free rent for a while. But again, we're not here to talk you out of doing rental properties, because actually I really think it's a great investment. And I try to encourage my clients that have them to keep it going, especially if it is producing and it's in the right spots. Just be aware so that you make that business work. And then be aware too, because I have noticed that a lot of clients, they get into their like late 70s and 80s. They don't want to run that business anymore.
They want to
Yeah.
farm it out.
Yeah,
Yeah.
so seeing a lot of people selling the rental properties in those age groups or doing different things or trying, maybe the kids take over. We've seen that within our practice, right? The kids kind of take over
Yeah.
if they're available and competent, so I don't know. It's a good question. All right. We've got time probably for one more.
Next one is, what are your thoughts on VMAX, VIMAX, the Vanguard Midcap Index Fund Admiral shares?
Admiral shares. Okay. So VMAX is basically mid-cap, investment through Vanguard. This was a question that came up in the comments after our last show, and so I'll give you a little quick rundown. There's actually mega cap now, that you think of the Apples and Microsofts, right? And then there's large cap, and there's mid cap and small cap, and then there's micro cap, right? There's kind of like the five size. When they're talking about cap, they're talking about the capitalization of the company. So you take all the shares times the value of per share, and that's what it's worth. So, NVIDIA has been working on $2 trillion or whatever, that kind of stuff. And so this one buys this mid cap, category. And so stocks would graduate up out of it or into it and come up from the small cap to mid cap or go from mid cap up into large cap, as things develop as far as that goes. So there's a little bit of rotation. But what I look at when I'm looking at an investment is really two things. Number one, how does it do versus the market, right? And then how does it do versus the other things that it could be buying, right? The opportunities that are out there. And so I'll give you just a brief kind of summary of what we do in terms of how our investment works. Number one, 3/4 of our portfolio, both on the bond and the stock side, is in the broad market. We try to buy things that have almost all the stocks in them, or a vast majority. Because if you really want to try to beat the market, you need to own a bunch of the market, because the money can move so fast and so radically, from one capitalization to another, or what have you, that you really can't play that game often. And so if you have like 3/4 of it already in that kind of what we call the core holdings, you're going to gain, or lack thereof, unfortunately, what's going on in the market. And so what we do is with the targets. So this mid cap would fit into our target category, okay? Because we're buying all caps with our core. Mid cap would be something we'd be buying because it was doing well. So we believe in momentum, and we want to find those things that are doing well. And so what we do, let me share this here. For example, we create these heat maps, and what we're trying to do is we're trying to optimize. So let's say for our target list right now, we have 149 ETFs, okay? And what we want to know, okay, is we own something. When do we get rid of it? So what we call the cut line. So right now, the cut line is 35. You have to be in the top 35 for us to keep holding on to that holding, right? And this one, actually, the Vanguard has an ETF that is the exact replica of that mutual fund, what we just talked about. And it's the Vanguard Midcap, and the ticker symbol is VO, VO. And so that's 46 on the list. So if we had owned it, we would have already sold it because it fell below our cut line. Now our cut line changes every quarter. We re-optimize. And what we're doing, that's what this is doing here, is this is an optimization. It's a heat map. And you can see that there's some dark green ones here, 55 and 57. What we're looking there is, how many days do we look back for the rate of return? So right now our cut line is, top 35 over the last 75 trading days. Okay, that changes, but the way we get that is off these heat maps, because if you look, that 57 is a little bit lonely, right? There's not as many green pieces around as that 55. I would probably pick, that's the rate of return, by the way. I'd probably pick that piece right there. And again, this is just an example. This is an older one that we used in a previous show. But that's important, because if you optimize something, you could end up with that 52 up there. See it?
Yes, I do.
It's surrounded by reds. What that means is that it's just a one-time lucky thing. I'd rather have more room for error and find a lot more green around it as a piece. So anyway, if we look at VO, all right, so that's this Vanguard Midcap ETF versus the S&P 500. S&P 500 is the orange, and the VO is the green. VO's done better since October 27th. So that run up that we've had, it's a 1% higher, right? And you can see it had a big jump up there in the middle, and then kind of came back down. And so, that's good. So it's done better. But if you look at the 149 on our list, we got things doing better than that, right? And so I'll give you some examples. These are some pieces that we've had since at least last May. I'm going to show you some of the good ones. The bad ones that we have get sold off because they get below that cut line, and we don't get them all right. But this is what's been running, right? So here is cybersecurity. Ticker symbol is IHAK, IHAK. This is an iShares fund that's specializes in companies doing cybersecurity, hot area, right? And we've been talking about scams and stuff. This is part of that from a business standpoint, and so that's up 31% in the same time frame. So again, more momentum coming in than the mid cap did. So we like that. If I had a choice, here's the next one. Sky, SKYY, which is the cloud computing, First Trust Cloud Computing. Again, that's up 34%. And then, of course, SOX, SOXX, which is the semiconductor ETF from iShares, which is up almost 55%. So I think that, just to summarize that, I think that that mid-cap fund is actually great. I mean, it's keeping up with the market, slightly ahead. I do think there'll be some rotation towards more smaller stocks as this kind of run develops and away from some of the bigger stocks that are currently kind of running the hardest. So it'll be sitting in a good spot there. But I'd probably be more interested in some of the more targeted areas because really we're just taking 25% of the rest of the portfolio and we're trying to find those waves that are running. And we want to get on that wave as early as we can, and we want to ride that until the wave stops, which for us right now, the cutoff top 35. So, that process is what really has worked for us. We have that mid cap in that list of 149. Excuse me. We don't have it in our portfolio because it's not, moving enough. And like I say, it's below the top 35 in this particular case as we stand. So nothing wrong with it, but I think there's better alternatives. Although I'm suspicious on this question, it didn't say, because it's a mutual fund, most people are doing ETFs now, but a lot of the 401ks have mutual funds. Yeah. And so sometimes that's an issue. You don't have a lot of choices. You can't buy any of those things I just said in a mutual fund often. I'm sorry, in a 401k. So that might be the perfect option if it's limited, right? Okay, good. Well, we're done with the show. I want to thank everybody so much for coming today. Again, send in your questions. We'll be back in a couple weeks. Ask Tom with Tom. Go ahead and subscribe to the channel. Hit the bell button to get notified. And then if you want to, set up an appointment and meet with Ethan and I. Excuse me. Thank you for coming.
Bye-bye. Happy Friday.